Today, on 1st February 2026, Finance Minister Nirmala Sitharaman presented the Union Budget 2026-27 in Parliament, focusing on sustainable growth, capacity building, and inclusive development as the three pillars of the fiscal strategy for India's next financial year. The government has projected nominal GDP growth of 10% for FY 2026-27, with a fiscal deficit target of 4.3% of GDP. Capital expenditure is sharply increased to 12.2 trillion rupees, signaling continued focus on infrastructure and long-term growth. There are no changes to income tax slabs or rates for individuals in this budget, continuing the structure from previous reforms. Both old and new regime rates remain unchanged for FY 2026-27. For clarity, old regime top rate 30% above 10 lakh rupees. New regime top rate 30% above 24 lakh rupees. A major reform introduced is the Income Tax Act 2025, which will replace the century-old Income Tax Act of 1961. This comes into effect from 1st April 2026, aiming for simpler compliance, fewer disputes, and lower litigation. One of the key reforms is rationalizing tax collected at source, TCS, across goods and services. The rate of TCS has been changed for various items. Securities Transaction Tax, STT futures, raised from 0.02% to 0.05%. Options premium, raised from 0.10% to 0.15%. Motor accident compensation, interest awarded to individuals is now fully exempt from tax, with no TDS. Dividend income deduction, special exemptions for cooperative federations for 3 years. Extended revised return filing, revised ITR deadline extended from 31st December to 31st March with a nominal fee. Foreign Asset Disclosure Scheme, one-time window to disclose certain undeclared foreign assets with a structured tax fee regime. TDS simplification, TDS on sale of immovable property by non-residents can now be deducted using the buyer's PAN instead of a TAN. Customs duty rates on goods imported for personal use have been slashed from 20% to 10%, potentially lowering prices for many consumer items. Exemptions have also been introduced for 17 cancer drugs, lowering healthcare costs. Semiconductors, launch of India Semiconductor Mission 2.0 with enhanced outlay and focus on full-stack local manufacturing. Agriculture and tech, introduction of Bharat Vistar, a multilingual AI tool to empower farmers with localized decision-making support. Rare earth corridors and high-speed rails, major investments aimed at strategic resource development and connectivity. Foreign investment limits, increased overall foreign investment limit to 24% and individual investment to 10% in certain categories, widening global participation. NRI relief, investment limit doubling and TCS cuts on overseas spending like tours and education reduce upfront outflows. The share of states in central taxes remains at 41% for the next 5-year period, providing continuity in fiscal federal arrangements. In summary, the Union Budget 2026-27 keeps personal tax slabs unchanged, introduces transformational tax laws, rationalizes TCS/TDS, boosts infrastructure and manufacturing, eases compliance, and continues a strong reform-driven agenda for India's economy.